welcome back. There's been some changes since we last caught up with this Div 296, mate. Some changes that I think will be well received by the wider community. Some changes which I think make a lot more commercial sense. So, mate, we were just talking earlier, there's three sort of major things that are changing around that. Do you want to talk us through those things? We'll get into a bit more detail.
Yep. So, I think common sense has kind of prevailed, kind of seems.
Definitely.
I think three main changes. There's a delayed start date.
Yep.
So
They've kicked it out a year.
Exactly. So I think everyone's in a bit of a tailspin because a retrospective tax never really excites anyone who's investors seeking certainty. So I think having a 1 July 26 start date is one of the major changes.
Yep.
The second one, major change is a tiered tax rate.
Yep.
So rather than just a blanket cut off at a $3 million member balance and the additional Div 296 tax implemented after that value, they've introduced a tiered kind of tax system, which is similar to marginal tax. So up to a $3 million, up to a $3 million super balance, you've got your standard 15% tax rate. So absolutely no change.
Yep.
Then from a $3 million member balance to $10 million, you've got a 30% tax rate. So they've effectively doubled the tax rate for members with the balances between 3 and 10 million.
Yep.
And then above 10 million, 40% tax rate applies. So
sure, but it's marginal though, right? So you're paying your standard 15% as you always were up to 3 mil, and let's say you crystallise the asset at 3.1, you're paying your 15% up to 3, then you're paying your 30 on your extra 100,000 over above.
Well,
or thereabouts.
Yeah, it operates very similar to marginal tax.
Sure.
So the way that I see it from a kind of structuring perspective is, the tax in super has gone up. It's obviously increased, that's the purpose of the tax, but it doesn't fundamentally change a choice of investing vehicle. Like we briefly touched on, where else would you go outside of super? Would you choose a family trust? Would you choose a company? Are there better tax rates being offered outside of super?
Yep.
And I think definitely up until 10 mil, you've got a 15% tax rate for those lower fund balances. You've got a 30% tax rate. That's before a discounted capital gain if we talk through concessions and things.
Yep.
And pension exemptions and various things. So you've still got good tax rates all the way up to 10 mil.
Yep.
And then even at 10 mil with 40%, if you've got these large member balances, that's per member.
I'm going to say per member, right?
So we're talking,
if you've got husband, wife and 2 kids, you effectively got 40 million.
Yeah. We're talking we're talking big fund balances. So
sure.
I think even then, where with some of the concessions and exemptions on pensions with the discounted capital gain, I honestly still don't think that the tax makes a fundamental change to how investors within self-managed super funds would consider commercial property investment or whatnot.
Yeah, sure.
I think that the third major change is obviously no tax on unrealised gains.
Yeah.
Which I think you would have probably received from your customers.
Absolutely.
A bit of pandemonium around that.
Oh mate, the uncertainty and just the paralysis that it created in the market for us. Like people just stood still and just went, I'm waiting until such time as there's a call that's made.
Yep.
And thankfully the call's been made, and I don't think they made as much of a hoo-ha about the repealing of it as they did about the announcement. It's kind of like it was a bit odd.
Yeah.
I felt so. And again, look, the initial video that we did, that we both sent out to our databases, like it was good feedback. It created a bit of market commentary. Started to cut it up. All of a sudden, it was like this happened. It was like boom, pump the brakes. We have to now talk about what the change looks like.
Yeah.
And again, I think it's a reasonable, logical position. I think the biggest change is going to be on the ongoing cash flow impost that potentially the investors would have had on, in particular, commercial assets. That would actually be sucked out of their return, where it's done at the end, right? So in terms of the capital gains discounts, I'm interested to see and understand what that discounting system looks like. Has there been any changes to that? From our understanding, if you owned the business and you operated, so an owner-operator, type property, then you sell the business and it turns into an investment. There was some concessions around that because it was a principal place of business. Obviously, the longer that you hold the asset, there was also some concessions around that. What does that sort of look like?
Yep. So I think there's no change to the actual capital gains tax rates within superannuation, but the way that I view it is, if I think about the opportunity cost of the alternatives of investing outside of superannuation and what does it look like? Should I be moving my assets into another environment? Within a self-managed super fund, you get a discount of 33.33% or a third. So if you make $100,000 of a capital gain within your super fund, then you're only taxed on $66,666.
Yep.
So that has not changed.
Yep.
But I think in light of the recent changes, the concern was taxing an increment in value that is unrealised. So with commercial property, the valuation on that $100,000 of, let's say, unrealised gains being levied a tax on that unrealised gain and not having cash flow to fund the tax. So the fact that they've removed the tax on unrealised earnings is a significant relief. Like you mentioned previously, the cash flow impact of that would have had investors and self-funded retirees concerned.
Absolutely.
But it doesn't, it's been repealed. So.
Yeah, I mean, the whole reason why you buy an investment is for return, right? And obviously, the higher the risk, the higher the return. I mean, typically yields around the Sutherland Shire sit anywhere between 3 to sort of 7%, depending on where your rents are. And if all of a sudden there was that additional impost of having to pay that ongoing tax, it may reduce those yields to a point where it became not attractive anymore, right?
Yep.
So, and I think that's probably been the success in this, is that I think that the wheels will start to get greased again. I think there's a lot of investors who have sat on the sidelines for the majority of 2025 waiting for this to happen.
Yep.
There's still a couple more weeks that are left of really good, real estate market, and then it sort of starts to filter off a little bit to the back end of November as we lead into Christmas. So I think, it's probably the right time for it to happen. I think it's the right time for people who have been holding off making decisions to still capitalise on opportunities. And I think we'll see a lot more quality investments start to hit the market as sellers have confidence, but also as buyers come back into that market as well.
Yep.
Anything else to add from that, mate?
No, I just think for long-term investors, I think the certainty of the revisions in the tax are only helpful for investor confidence. You're not going to be paying tax on unrealised gains, so you can invest with certainty. You can hold assets. You don't need to sell them. You're not going to be taxed on the volatility in earnings in any particular year. So listen, I think it's probably just a sensible outcome.
Agreed. Agreed. Excellent. Thanks for coming in, mate.
Cheers, mate.
Ta.
Thank you.